All right, awesome. I see some familiar faces. I've been with Richard in the Family Office Club now for about a year and a half. I've spoken at a few of the events. Very, very pleased with the interactions. Big thank you to Richard and his team. I thought it might be nice to give Richard and his team a nice round of applause at the beginning of the day. That'd be okay. So as Richard mentioned, what I'd like to do is spend a few moments talking about self-directed, as we call it, self-directed IRAs. There are other types of accounts as well. Richard mentioned HSA, solo 401k. And what I'd really like to do is introduce some of my experiences around working with high net worth individuals, ultra high net worth individuals, and family offices. And I always say that I was really privileged 15 years ago to stumble into this business. My background was in real estate and academically was in finance, and that started about 20 years ago. And academically, what was ingrained in my mind, what I was really conditioned to think, is that the only way to invest with an IRA, 401k, defined benefit plan, other type of retirement account was invest in the public markets and really be focused on the 60-40 model, 60% public equities, 40% fixed income. So that was all I learned about. And at the same time, I was working for a real estate company based out of Cleveland, Ohio. And I went to the founders of this real estate company. They own mainly commercial properties, but there was some residential properties in there as well. And I said, why don't you guys have IRAs, 401ks, SEP IRAs, simple IRAs for the office? Why aren't you utilizing these accounts? And they passionately said, well, we don't believe in the public markets. We don't believe in the stock market. We've made all of our wealth in real estate. We're leaving a legacy to our children and grandchildren in real estate. And so we don't believe in those types of accounts because we don't believe in the stock market. And I thought, okay, well, I guess that makes sense. And then 5 years after that, fast forward 15 years ago, I met our company founder. His name is Dick Desich, and he's widely known as the pioneer of the self-directed IRA industry. He started a predecessor company, which became Equity Trust back in 1974. And he put together one of the very first real estate syndications with IRA investors in 1983. That's when we got our first IRS determination letter to be a custodian for these hard to value assets, these unique alternative investments. He actually had about 22 IRA investors all invested in a real estate deal based out of Cleveland, Ohio. And over 19 years, each of those investors with only about $6,000 invested made nearly $200,000. And so that was sort of the flagship transaction. And then he went on to do a number of other deals with a number of other investors across the country. And then he really started bringing this and introducing this concept of self-directed IRAs, investing in alternative assets, to the masses. So we started with about 22 IRA investors back in the early 80s, and we now have well over 200,000 customers, and we have under custody and administration about $39 billion in assets. So over the course of the last 15 years, I've had the opportunity to have a seat at the table with a lot of family offices, high net worth individuals, and ultra high net worth individuals. Now, I was typically the individual that was consulting these individuals on how they could convert money from their traditional to their Roth IRAs over time, how they could custody unique alternative assets, how they could get creative with LLC and trust structures using their retirement plans. So that was my part, or my sort of seat at the table. But what I'll tell you is I learned a ton from these individuals over the last 15 years. And there were some instances where I would have a seat at the table and I would make no money. I'd spend a couple $1,000s, fly wherever they're at. I'd sit down at the table. I didn't make any money, but I was okay with that because the lessons that I learned from them and the information that I got from them on how they were running their office and running their business, I was then able to take that information and share it with the masses, share it with other high net worth individuals, other family offices, and then also to the individual everyday investor. So we service, it runs the gamut in terms of the types of clients we service, from the individual that's just getting started with $15,000 or $20,000 in an IRA. Maybe they're an accredited investor, maybe they're not, doesn't really make a difference, just depends on, of course, the opportunity they're investing in, to the individual that has a $72 million Roth IRA. So one of my clients, I'll consider it my top client right now, he has $72 million in a Roth IRA. He'll never pay a single dime of tax on that money ever again for the rest of his life. And he is now introducing his adult children and his grandchildren into self-directed IRA investing into the private markets. So what I'll do is just share with you quickly sort of 3 very high-level strategies that I've learned from these individuals, and hopefully you can take away some of this information. And of course, if you're someone that says, I want to raise capital from IRA investors, or I want to deploy capital of my own, or individuals that I represent in self-directed IRAs, I'm here to be able to help provide information and more education on that. So the first, of course, is just the idea of using what I'll call tax-free accounts. And so if you are working with someone or yourself, if you have a tax-deferred 401k, traditional IRA, defined benefit plan, pension plan, these are all types of accounts that you have the ability to deploy capital or allocate a portion or all of that capital into the private markets, into private market alternative investments. And when I say private market alternative investments, I'm talking about real estate syndications. That's a big part of our business. Physical gold and silver, even digital assets like cryptocurrency. But you will find much of our passion and a lot of what we work with day in and day out is real estate, private equity, and private direct company investments. That could be in the form of equity, that could be in the form of debt, that could be in the form of a convertible note or a safe agreement. It really runs the gamut. We're an alternative asset custodian, so we're not going to look at an investment and underwrite it for suitability for the investor. We're a non-fiduciary custodian. So as long as it checks all the boxes and it's not something under 4975 of the tax code that's considered a prohibited transaction, then we're going to permit that investment to be held with us as a custodian. But these are the different types of accounts. You'll hear of a lot of folks talk about a Roth IRA, and I'll just spend a moment there. So with high net worth individuals, family offices, and ultra high net worth individuals, I've spent the most time with these individuals talking about Roth IRAs because of the concept of being able to put money in after tax or convert existing money and put it into an after tax Roth environment, grow the account 100% tax free, and never pay a single dime of tax ever again for the rest of your life. And oh, by the way, the account avoids probate. You can leave it to your children, potentially your grandchildren, and it's a tax-free account to them. We like to call those tax-free legacy accounts golden Roth IRAs. That they're really, I consider them to be the unicorn. When I come across someone that has an inherited Roth IRA, I immediately want to provide some attention there because there's so much that you can do from a tax-free perspective. You'll hear me say a lot, compounding interest in the absence of taxation. And to put this into perspective for you, I have a client that is, I mentioned he has $72 million in a Roth IRA. Now, you don't get $72 million in a Roth IRA just purely through making contributions because you can only contribute $6,500 to a Roth IRA on an annual basis when you're 50 and over, $7,500. So how he got there over time was through converting tax-deferred money from his defined benefit plans into the Roth IRA, and then from there aggressively pursuing private market investments. In fact, reported by the IRS, there's only 9,000 Roth IRAs that have a balance of $5 million or more. And the IRS reported that 25% of the reported value are in hard-to-value assets. Do you know what hard-to-value assets are? They also call them unconventional investments. They're private market investments. Real estate, private equity, and private direct company investments are the 3 main ones that they reference. Because the IRS does know now what types of private assets are held in IRAs. There's a special tax document called a 5498. So if you guys are interested in light reading after today's program, you can spend some time with me. 5498, Internal Revenue Code 4975. Richard knows I have super dry jokes. So when I tell one, you just laugh at me. Good? Okay. Richard mentioned a solo 401k. If you are a self-employed individual or you're working with somebody that's a self-employed individual, you can look at a solo 401k. You can contribute a lot more to one of these 401ks than you can an IRA on an annual basis. And then last but not least, a health savings account or a Coverdell education savings account. For saving for healthcare or education. A lot of people underestimate the power of a health savings account. You can get deductions going in, you can grow it tax-free, you can take it out and you pay 0% tax, so as long as you use it for healthcare related expenses. I have a woman that I work with out of Phoenix, Arizona. She has $250,000 in her HSA account. And I said, why aren't you using that? She said, well, I don't want to use it now for my healthcare. I want to keep it long term. So when I need assisted living care, I have the ability to be able to take that money out 100% tax-free.